Hello, everyone, and welcome to The Silent Economy. On February 4th, 2022, Vladimir Putin and Xi Jinping signed a document that many in the West simply called a friendship declaration. But they were catastrophically wrong. Buried deep inside that document was a clause that should have set off alarms everywhere. An agreement for mutual trade in their own currencies, completely bypassing the US dollar and Western financial systems. Fast forward to today, and what was once diplomatic language is now a reality. A shadow trading network is moving billions in commodities, from Russian mines to Chinese refineries, gold, uranium, natural gas, and especially silver. Russia, the world's fourth largest silver producer, used to send its silver to London. Now it all flows to Shanghai. This isn't just a trade shift, it's the foundation of a parallel financial system, and it could pose a major threat to Western markets. Stick around as we break it down. Ever wondered what Russia and China are really building together? It's not just talk. It's a massive commodity alliance built on three key agreements that are completely changing how global resources move. Let's break it down. First, there's the 2022 Strategic Partnership. When it was signed, many in the West thought it was just diplomatic fluff. They were wrong. The agreement specifically commits both countries to stop relying on other nations' financial systems for their own trade. It guarantees that they will supply each other with critical resources, especially during global crises. And it created a special group to cooperate on precious metals. This isn't just theory. Today, every major Russian commodity producer deals directly with Chinese state companies. Their contracts are in yuan, settled through Chinese banks, and delivered to Chinese ports. They've effectively bypassed the entire Western financial network. Next up is the BRICS Commodity Exchange Framework, established in 2024. The BRICS countries, Brazil, Russia, India, China, South Africa, and new members, are building their own unified trading platform. While some details are still under wraps, we know it includes a system for settling trades with precious metals, backed by physical gold and silver stored in member countries. Think of it as the early blueprint for a trading currency backed by real assets. It's not meant to replace the dollar overnight, but it creates a parallel track where these nations can trade without ever touching it. Russia supplies the commodities, China provides the manufacturing power and the money, India brings huge demand, South Africa has platinum, and Brazil offers agricultural goods. Silver is the key lubricant that makes this whole alternative engine run smoothly. Finally, and this is the one that has intelligence agencies on high alert, is the Bilateral Precious Metals Protocol. Signed in March 2024, this agreement set up direct cooperation between the central banks of Russia and China on their gold and silver reserves. They're now coordinating their purchases, sharing refining facilities, and even providing storage for each other. Since Russia can't store its reserves in London or Zurich anymore due to sanctions, where do you think they're putting them? In Shanghai. Satellite photos show less activity at Russia's main precious metal storage facility. The metal is on the move, relocated to Chinese vaults where it's safe from Western sanctions. This isn't speculation. This is what's happening right now. And it shows just how central silver has become to this new global economic order. Thanks for watching, and don't forget to subscribe for more deep dives like this. How does sanctioned Russian silver end up in Chinese vaults, completely bypassing Western financial systems? The answer lies in a sophisticated process that's hiding in plain sight. Let's break down this shadow pipeline, step by step. First, you have to understand the source. Russia produces about 43 million ounces of silver annually, mainly from regions like Magadan in the Far East and the Urals. Before the 2022 sanctions, roughly 70% of this silver flowed west, through European ports to Swiss refineries, and finally into London's vaults. But when the EU and the London Bullion Market Association slammed the door shut, that silver didn't just vanish. It found a new direction, east. This brings us to the rerouting stage. If you look at customs data from the mainland crossing between Russia and China, shipments of non-monetary metals, a category that includes silver, have skyrocketed by 340% since 2022. Similarly, shipping from Russia's Pacific port of Vladivostok to China is up 280%. The silver is moving, either as raw concentrate or refined bars, through channels completely outside of Western oversight. Once it crosses the border, the magic happens. This is stage 3, Chinese refining. Russia sends what's called silver concentrate, which is raw ore containing silver, lead, and zinc. It enters China classified as a base metal ore. Refineries in provinces like Henan and Hunan then process it. They separate the metals, and the finished silver bars that emerge are stamped with Chinese hallmarks from LBMA-accredited refiners. Legally, they are now Chinese products. The Russian origin has been completely washed away. Interestingly, most of this silver doesn't get re-exported. It flows directly into the Shanghai Gold Exchange, or China's strategic reserves. So, how does Russia get paid for all this? That's the final piece of the puzzle, settlement. The entire transaction is settled in Chinese yuan through CIPS, China's alternative to the SWIFT banking system. Russian mining companies get paid in yuan, which they can then convert to rubles or use to buy Chinese goods. The US dollar is never involved. Western financial surveillance is completely circumvented. This isn't some back alley smuggling operation. It's a state-level commodity system draining 43 million ounces of silver from the global market each year, right under our noses. Thanks for watching. If you found this breakdown insightful, be sure to like this video and subscribe for more deep dives into the hidden mechanics of the global economy. Let's break down what the loss of Russian silver supply really means for the prices we see in the West. For years, the global silver market worked on a simple idea. Silver is silver. Whether it came from Mexico, Peru, or Russia, it all ended up in the same global pot, feeding refiners, vaults, and exchanges like the COMEX in New York and the LBMA in London. But the new Russia-China Pact has completely shattered that assumption. Suddenly, 43 million ounces of silver that used to be part of the global Western supply chain are now permanently rerouted to the East. That's about 5.2% of the entire world's yearly mine production, just gone, wiped from the Western ledger. But the real impact is much, much bigger than that number suggests. Let me explain why, starting with what's called the marginal ounce problem. Commodity markets, like silver, are priced at the margin. This means the price of the very last ounce sold sets the price for all the other ounces. Think about it. Western demand for silver hasn't gone down. Our industries still need about 580 million ounces every year for things like solar panels and electronics. On top of that, investors buy another 200 to 300 million ounces. The demand is still there, but the supply to meet it has shrunk by 43 million ounces every single year, for 3 years straight. That's a cumulative deficit of 129 million ounces. To put that in perspective, that's more than the entire registered inventory of the COMEX exchange. The last ounce needed to meet demand used to come, in part, from Russia. Now it has to be pulled from somewhere else, from already draining reserves in London, from the dwindling stockpiles at COMEX. The math is brutal and unforgiving. Next, we have the arbitrage trap. Normally, if the price of silver is higher in one market, say Shanghai, than it is in London, traders would buy it cheap in London and sell it for a profit in Shanghai. This flow of metal evens out the prices. But the Russia-China Pact broke this mechanism. Russian silver now flows directly to China, paid for in Chinese yuan. And it doesn't flow back. China has strict controls that prevent refined precious metals from being exported. Meanwhile, Shanghai prices are consistently 10 to 12% higher than in the West. This should be a magnet for Western silver, right? But the arbitrage only works one way. Metal can flow east, but it can't return. The Western system is effectively bleeding silver with no way to get it back. This leads us directly to the LBMA vault hemorrhage. For 300 years, London has been the heart of the global precious metals trade. The vaults there are supposed to hold the physical silver backing the entire market. In 2021, those vaults held 1.18 billion ounces of silver. Today, they hold just 723 million. That's a drop of 457 million ounces in only 3 years. This isn't just a market fluctuation, it's a structural drain. So where did all that silver go? Some went to US-based ETFs, but their holdings have actually gone down. A big chunk went to India, which had record silver imports, but that only accounts for about half of the outflow. The rest is flowing east, to Dubai, to Singapore, and especially to Shanghai. It is being pulled by those higher prices and the huge Chinese industrial demand that is no longer being met by its Russian supply. The Russia-China deal created a massive supply hole, and the London vaults are being drained to fill it. Finally, let's look at the COMEX vulnerability in New York, the registered inventory at COMEX that, as the silver actually available for someone to take delivery of, has collapsed from 150 million ounces down to just 38 million. Month after month, more and more buyers are demanding physical delivery instead of just rolling over their paper contracts. Industrial users are getting nervous and are buying up physical metal as insurance against supply disruptions. If this drain continues, the registered inventory at COMEX could hit zero within 18 months. What happens then? We could see a delivery failure, forced cash settlements, or emergency rule changes that would expose the paper silver market for what it might be, a confidence game backed by not enough metal. The Russia-China Pact didn't single-handedly cause this crisis, but it poured gasoline on the fire. By taking 43 million ounces of silver off the Western table each year, it dramatically accelerated the timeline. They have effectively weaponized scarcity, and the consequences are now becoming impossible to ignore. Thanks for watching. Be sure to subscribe for more deep dives into the markets. Let's talk about why Russia and China are making this huge move with silver. This isn't just about making a quick buck from rising prices. These are major world powers. They don't need to speculate on commodities. What this is really about is building a brand new financial system from the ground up, one that can not only survive without the US dollar, but eventually replace it. And silver is just the beginning. Think of it in phases. Phase 1 was all about proving it could be done. By successfully moving Russian silver through the Chinese system, they've shown the world that a major commodity can be traded completely outside of Western control. Sanctions? Bypassed? Payment systems? Replaced. This was a critical test, and it passed. They now have a blueprint for what works. So what's next? Phase 2. Expansion. The same channels they built for silver can be used for gold, palladium, nickel, copper, you name it. Russia produces a huge amount of these resources, 10% of the world's gold, 40% of its palladium. All of that can now flow through this new non-Western pipeline. And China? They already dominate the processing of rare earth minerals and other key metals. Together, the Russia-China partnership controls or processes a staggering 60 to 70% of the world's most critical minerals. The silver deal was the template. Now they're ready to apply it to everything else. This all leads to phase 3, the endgame. And this is what should have Western markets genuinely concerned, creating a new way to set prices. Right now, prices for gold, oil, and everything else are set in US dollars on exchanges in New York and London. This gives the West immense financial power. But if the actual physical metal isn't even passing through Western vaults anymore, those exchanges start to lose their meaning. Look at the Shanghai Gold Exchange. It already handles more physical gold than its New York counterpart. The Shanghai Futures Exchange is rolling out more and more contracts priced in Chinese yuan. If 40% of the world's silver supply never even enters the Western market, then the prices set in London and New York are based on a shrinking fraction of the real supply. The true price will be discovered in Shanghai. The Western price will become a fantasy. This isn't some far-off theory. It's the logical conclusion of everything we're seeing happen right now. They're not just stockpiling commodities, they're taking control of the very mechanism that sets their price. And that brings us to the nuclear option, the scenario that gives Western traders nightmares. What if the BRICS nations, led by China and Russia, announce that all trade between them will be settled against a basket of physical precious metals stored in Shanghai and Moscow? Instantly, the value of gold, silver, and platinum would skyrocket to reflect their new monetary role. We could see gold at $5,000, silver at $150. Western paper markets would simply collapse under the strain. This isn't happening tomorrow, but the foundations are being laid today. Thanks for watching. If you found this breakdown insightful, be sure to like this video and subscribe for more content that goes beyond the headlines. See you next time. How do you position yourself for a world where a new alliance is taking control of commodity supply chains and price discovery? You follow the protocol. First, Rule 1. Recognize the bifurcation. The global commodity market is splitting into two distinct systems. You have Western exchanges where inventory is shrinking and Eastern exchanges where reserves are piling up. Don't assume that prices on Western markets reflect the global reality anymore. Increasingly, they just reflect Western scarcity. Keep a close eye on Shanghai premiums, on BRICS settlement announcements, and on the UN's growing role in commodity invoicing. This split is happening fast, so position yourself accordingly. Next, Rule 2. Hold physical assets outside the paper system. Think about it. If a major exchange like comex fails, shares in paper assets like SLV could become claims on nothing. If London vaults empty out, unallocated accounts become unsecured creditor positions in a bankruptcy. But physical silver, in your own possession, has no counterparty risk. It exists in both systems and is real money no matter which one wins out. Acquire the physical metal while Western markets are still functioning and store it securely. Most importantly, don't reintroduce risk by using third-party custody. This brings us to Rule 3, diversified jurisdiction. The Russia-China Pact exists largely because Western sanctions created it. When the West froze $300 billion in Russian reserves, it sent a clear message to every other nation. Your assets in Western jurisdictions can be seized at any time. You should consider storing some assets in neutral jurisdictions like Singapore or Dubai. This isn't about tax evasion, it's about prudent diversification against geopolitical risk. Rule 4 is simple. Monitor BRICS announcements. The framework they're building is still evolving. Every BRICS summit adds new pieces to this alternative system. Watch for announcements about commodity-backed trade settlement, precious metals reserve coordination, and the formal launch of a payment messaging system to replace SWIFT. These announcements will move markets long before most Western analysts even grasp their importance. Finally, Rule 5. Scale your position to the risk. This isn't about speculation. It's about preparing for a systemic change. The Russia-China alliance represents a fundamental restructuring of global commodity markets. This might take 5 years, or it might take 15, but the direction of travel is clear. Consider allocating 15 to 25% of your liquid assets to physical precious metals. That's enough to benefit from the repricing, but not so much that a timing error creates hardship. It's all about patience and positioning. The Pact is operational and the consequences are coming. Thanks for watching, and be sure to subscribe for more insights. Here's the strategic summary you need to hear. On February 4th, 2022, Russia and China signed a pact that went far beyond mere diplomatic language. It was the blueprint for a new parallel financial system. And now, that blueprint has become operational infrastructure. Think about this. Russian silver is no longer flowing west. It's now heading east through channels completely invisible to Western surveillance. We're talking about 43 million ounces every single year. And how is it paid for? In yuan. It's refined in Chinese facilities and stored securely in Shanghai vaults. Let's be very clear. This isn't about smuggling. This isn't about dodging sanctions. This is the intentional construction of a brand new commodity trading architecture, specifically designed to bypass and ultimately challenge Western financial control. And the most important part? It's working. The silver is flowing and a powerful precedent has been set. So what comes next? Gold will follow this path, then palladium, then nickel, uranium, copper. All of them will start moving through these same new channels. Meanwhile, what's happening in the West? The London Bullion Market Association is seeing its inventory bleed out. The comex is getting dangerously close to a delivery crisis. The prices we see in the West are becoming more and more disconnected from the actual physical supply. Over in Shanghai, the mountain of silver just keeps growing, month after month. It's priced in yuan, controlled by the state and completely beyond the reach of any Western sanctions or seizure. While the West clings to the belief that it can sanction its way to commodity security, Russia and China are proving them wrong. They aren't just hoarding resources. They are building the entire system to price them, to trade them, and, if necessary, to weaponize them. This pact isn't some future threat. It's a present reality. It's already operational. It's expanding. And it's accelerating. So the real question isn't if this will shake up Western markets. The question is when. Will you be prepared before the great repricing begins? The architecture has been built. The silver is already flowing. The crash will come when the West finally looks inside its vaults and realizes they're empty. This is the silent economy. The protocol is active. Remember to do your own research. Thanks for watching.